Hello dear traders, the US stock market had the best week of the year. The key indices jumped by more than 5%. Investors expect a loose monetary policy after the recent Fed meeting and the publication of labor market figures. Against this backdrop, demand for risky assets is mounting. Markets are also preparing for the issue of corporate reports. However, this week the main focus will be on monetary policy. Investors continue to estimate the prospects of interest rates. Not so long ago, Minneapolis Fed President Neil Kashkari said the central bank would have to do a lot to keep inflation under control. That's why traders will take a closer look at the statements provided by some Fed officials, including Jerome Powell, to find some hints about the regulator's plans for the next year. Stay tuned, the financial market is always reaching unexpected and interesting events. Watch the video to the end and share your opinion in the comments. On Friday, Wall Street closed in the green, thus the S&P and Nasdaq added 0.9 and 1.4% respectively, while the Dow Jones closed with an increase of 222 points. The market reacted in response to the employment report, which unveiled that the US labor market cooled more than expected a month ago. Traders strongly believe that the Federal Reserve has ended its hiking cycle. In this light, companies specializing in finances and materials were among the beneficiaries. Meanwhile, the tech sector faced difficulties amid a decline in Apple's shares. The company's earnings exceeded forecasts, but sales dropped for the fourth quarter in a row. Nevertheless, its managers said that they did not expect any changes in earnings. The beginning of the week was also positive but quite calm. On Monday, US stock indices closed slightly above the zero line. Apple's stocks climbed by 1.4%. Tech and healthcare companies showed the best results. Stocks of Microsoft, Amazon, and Nvidia advanced by about 1%, while Eli Lilly's shares soared by 4.8%. The previous week was decisive. US stocks reached their price bottom on Friday. Later, we saw a considerable rebound. The FOMC's decision to keep the key rate unchanged at 5.5% did not surprise traders. However, the following comments were considered prerequisites for the end of the hiking cycle. Of course, a switch to a looser policy will hardly take place soon. It could be seen at the beginning of the summer of 2024. Nevertheless, market expectations are soaring. Investors are trying to benefit from the situation, while bears are rapidly closing their positions. This, in turn, has led to a jump in the indices. Under the current economic conditions, a drop in US labor market indicators is taken as a positive signal. The low employment rate allows the Fed not to raise the key rate. Traders in the CME Group futures market see a 51% likelihood that the Fed will start lowering rates in May, while previously such changes were expected no earlier than July. Last week, the Dow Jones surged by 4%, manifesting their best performance since October 2022. As a rule, in November, the US stock market grows. The average yield this month totals 2%. This year, in the first days of the month, the market surged by more than 5%. Notably, before the trend reversal in October, the indices slumped to a 5-month low amid the mounting tension in the bond and currency markets. As a result, the jump in November is a reaction to earlier sell-offs. In this light, a record number of long positions after the tumble was a noticeable event for US stock indices. In addition, some fundamental factors encourage buyers. However, the market may soon face technical obstacles. On Monday, there were some signs of a possible correction. However, it's too early to make predictions. The fact is that US tight monetary policy is still in force and bond yields have resumed climbing. At the same time, the US dollar is recovering after decline. Thus, early on Tuesday, the 10-year bond yield once again consolidated at 4.65%, while the US dollar index exceeded 105.3 points. It means that the continuing rise in the US stock market may slacken. The S&P showed the best result in a year from a technical point of view. The S&P has already recovered by 5% from its low around 4,100 points. The VIX volatility index, which displays sentiment in the stock market, experienced a 30% drop over the past few days. The day before, analysts assumed that the stock index could reach a resistance level of 4,330. The indicator climbed even above this mark. The highest level was recorded at 4,360. Thus, the short-term forecast has already come true. Judging by the previous week's close and the beginning of the current week, the indicator may stagnate near the high or decline. The S&P stopped slightly below 4,400 in an attempt to touch its high. There is both horizontal and dynamic resistance formed by peak levels. It means that buyers should be very attentive to avoid possible losses caused by locking in profits on long positions and the rise in bearish activity. The Nasdaq 100 advanced by 5.1% in the last 7 days, making the best week since November 2022. In general, the situation is quite favorable for the indices. Although the correction is possible, there is some probability of further growth. So what we will see? Unlimited growth or decline? Let's find out. October, a month that ended last week, did not bring the expected New Year's growth in the stock market despite favorable forecasts of seasonal statistics. So far, we have only seen a short-term jump. Over the past 3 months, the market has been constantly losing value. The final corrective drop totaled a significant 10.4%. This is a considerable decrease in the value of assets. The drop occurred amid the reporting period for US companies. About 82% of the companies in the broad market index exceeded analysts' expectations. Market leaders are also showing impressive results. The weakening labor market is one more factor that indicates a decrease in inflationary pressure. It's quite possible that such a correction could be followed by growth, but it is just an assumption. In October, the market also dropped, but less sharply, by 2.17%. In November, it has already increased by 5%. Nevertheless, it's too early to conclude about the monthly results. The fact is that the existing growth is quite limited and reflects the current state of affairs. The US dollar index is boosting the dynamic of risk assets, and its fall in November is equivalent to a rise in the stock market. Although risk assets may increase in the near future, the Santa Claus rally is still possible. What's more, this scenario seems to be more reasonable than a further decline in the market. And we continue to monitor the stock market situation to keep you abreast of the latest events. Subscribe to our channel and leave your comments. We are working for you, making the most relevant video reviews every day and every week. That is all for now. See you later.